Holy crap, what a crazy day for markets. There's a lot of big news that we need to cover, but first, let's share this clip from CNBC and Tom Lee defending the small cap trade going into tomorrow's FOMC report and press conference from Jerome Powell at 2:30 p.m. tomorrow.
IO and CNBC contributor Peter Bookvar and Tom Lee, Fundstrat Global Advisors managing partner and head of research, also a CNBC contributor. Welcome to you both. I'm half joking, but Peter, it's been a long time. I mean, they telegraph everything. The markets price this stuff in well in advance. We talk about the downsides to that, but that's the world we're living in.
Well, Powell focuses a lot also on signaling, as an institution they do as well. So Powell is basically laying out the blueprint for the September cut, which he'll do on Wednesday. But he's of the attitude, well, if I cut on Wednesday, even though I have every reason to, but if I do it and the market doesn't expect it, well, then maybe I'm implying that I'm worried about something.
Exactly. And we saw that with Dudley last week when he wrote that Bloomberg piece, and everyone said, well, what does Dudley know that we don't? Is there any way, Tom Lee, that Bill Dudley knows something we don't at this point, given? I just find that implausible.
I mean, I don't think any FOMC official or former Fed knows anything the market doesn't. I think it's just their judgments about the state of the economy. I mean, I think there is evidence the economy is pretty soft, whether you're looking at housing sales or autos or durable goods. But yeah, I kind of agree with Steve and Peter that a cut for this meeting would probably not be viewed positively.
Yeah, Peter, expound on that a little bit.
Well, I think things are lining up for that cut. And
in September.
But I can argue that it's things have lined up for Wednesday. Mm-hmm. But the Fed likes to sort of game plan things out. They don't want to be caught stuck having to slash rates. They don't want to have to be caught spiking rates, which was their experience over the past 4 years. They want to be sort of in control of this conversation. But at the back of Powell's mind is, yes, I'm going to give you some rate cuts, but I may not give you the amount that you want because I'm still worried about inflation. Yes, inflation's in the 2 range. I'm very happy about that, speaking as of Powell. But my concern is that I lose control of this credibility that I've worked so hard to get back.
Absolutely, and we were talking on Friday a little bit in the weeds about whether potential GDP is actually higher than we realize with Mark Zandi, but Tom mentioned that he thinks that things are slowing down. Do you think things, Peter, are slowing down? Or it's hard to tell because the areas that are softest are the areas that are resetting post-pandemic. So even McDonald's, I cited this example today, but they have negative comps. It sounds like a disaster for the consumer, but Chipotle's up 11%. McDonald's just took the price of a 10-pack meal to $9.19. So I don't think their softness is telling us that the broader economy is soft so much as that it's resetting.
I'm seeing a lot of softness. And one thing between Chipotle and McDonald's, and I've seen surveys on this, if I go to Chipotle for $10, I can get 2 meals. Mm-hmm. If I go to McDonald's with $10, I'm getting 1 meal. So there is a reason why Chipotle is doing well. The consumer is still approaching both restaurants with the same sort of budget value type seeking mentality. And to me, the economy is softening. And I'm seeing that across the board. The only thing that's strong for the economy that I see is the higher income consumer, the baby boomer, and government spending. and spending on AI and all the CapEx associated with that. Most other parts
consumers, baby boomers, anything associated with the government and AI. That's
I'm seeing weakness across the board elsewhere.
Interesting. Steve, jump in here.
Well, I was just going to get back to what you were talking about. Tom talked about this idea about the Fed surprising. I just don't think there's a reason for them to surprise here, in part because the committee, I don't think Powell has the whole committee right there right now when it comes to cutting rates. I think there may be half or slightly less than half that are ready to cut now, but not the full committee. And I think one of the things you want to do is Powell's going to want to have his whole committee with him when he does so.
But Tom, I don't think you're saying that you think they were going to cut this week. And we talked a little bit about what you think is going on here with equities. And a lot of people say it's because of the Fed cut coming that the Russells, for instance, are doing so well. So I was curious, Mr. Lee, if you could kind of just bring this full circle for us. How much further should small caps rally based on the fully priced cuts we already have and the fact they're probably not going to cut in 2 days?
Well, I don't think the Russell's rallying because they were expecting a July Fed cut. I think the Russell 2000's rallying because I think the cyclical side of the economy is going to get a lifeline if the Fed is committed to cutting rates once or twice or even 3 times this year. The things like durables and housing and autos, they will inflect. I think that's why we're seeing strength in regional banks and even cost of capital sectors like biotech. But to me, I think the small caps have quite a lot of room to run because there's been a huge breadth expansion. 11 out of 11 small cap sectors are outperforming their large cap peers, but 8 of them have actually broken out to almost 1-year highs on a relative basis. So there's a huge expansion of breadth at a time when we know positioning is still really light. Most investors are still, if you look at Russell futures, are still net short small caps.
Peter?
I think there is some benefit that small companies are getting from the hopes of a Fed cut. I mean, a lot of these small companies have floating rate debt.
Yeah, the Russell hasn't made money in 3 years.
They would love a reduction in SOFR since they're borrowing that plus.
Absolutely.
So I do think that there's some balance sheet hopes that a lot of these small companies have. If you're in commercial real estate, you're praying for a lot of rate cuts in particular.
Are these flip sides of a coin, though, that you could get maybe a cyclical lift in the economy with the help of lower borrowing costs? I mean, do those go hand in hand?
I'm not sure 2 to 3 cuts are really going to move the needle on the economy. And I think that we can't rule out the possibility that long rates actually stay elevated or even go up while the short rates actually go down. People just assume, the Fed's going to cut, the 10-year yield goes down. That's usually worked.
Was it Wednesday? We saw that steepening, and all of a sudden, again, you're looking at the 10-year and wondering, soft data, it just didn't, it was not reflected. That was the wrong area to look. It was all in the 2-year.
I'm in the bear steepener camp. And so is Fed cuts going to help me if I'm priced off the 10-year, my borrowing?
If you're buying a house, for instance, that's how Steve and I get into this discussion all the time. Tom, do you want to just quickly respond to that? And then, Steve, I'll bring you in. Tom, just a quick word on that.
Kelly?
Yeah, go ahead. No, go ahead, Steve. It's fine.
I was just going to say, Peter's right on the cutting edge of what a big question is here. There's a lot of short-term uncertainty about when the Fed cuts this year and how much it cuts. As I showed in my report, the market has 3 built in. Economists say more like 2. But the more important question for all these valuations is how much the Fed actually ends up cutting. The futures market has 150 basis points of cut built in through the end of next year. That might be a little bit aggressive as to how much cutting is actually coming down. And that is key to how the curve reinverts or remains inverted, or because what would happen is the 2-year would fall, and does it pivot around the 10-year? Or does the 10-year come down with the 2-year? And that's really a big question. It's a big question for businesses and borrowing, but it's also a big question for valuations and stocks.
It's probably the most important one, which is why I took some, I guess you'd call it relief from the fact that the 10-year dropped to 417 today for kind of, I don't know, no reason it seemed to me. Tom, just give us a word on the market more broadly here. What do you think is going on?
Well, I actually just want to point something out. You said that Russell 2000 is a money-losing index. That's actually a misconception. The reason the percentage of Russell companies have negative earnings is almost solely due to the increase in the number of biotech stocks in the index. Ex-biotech.
Not that stat, and I appreciate the stat that I've heard, and I wonder if this is true, is that Russell 2000 earnings for 2023 or 2024 were literally the same as they were 3 years ago. That companies in that, and on aggregate, they have not earned more.
Sure, but nobody buys stocks on 2024 earnings. If you look at 2025 earnings, Russell earnings median is 700 basis points higher than the S&P.
Wow.
The median PE in the Russell is 11 times. The median PE in the S&P is 16 times. You're buying a much cheaper index, buying the Russell 2000 with a lot more earnings growth, and I think a lot more operating leverage to, if cost of capital falls and liquidity improves or commercial real estate stabilizes, these are huge fundamental catalysts for small cap stocks. So I think there's a lot of people are too dismissive of thinking small caps are just a trade here.
Yeah, and I guess, Peter, the most important thing is to clarify to those who think there's no way you can get 2 $5 meals at Chipotle. I know from bringing kids there that you can, but I don't know if that's what you were talking about in terms of why that has more value than than $10 at McDonald's.
Well, I think that's why there was such a big deal about is Chipotle shrinking the size of the food they put in their bowls.
Totally, yes.
Because there's a very generous portion there that you can create.
See. So if you're like my parents who can
it.
eat 2 meals out of one Chipotle bowl.
Right. Or just any value-conscious consumer that they can have one for lunch, one side for dinner.
Yes, absolutely. All right, we appreciate it.
So again, as Tom Lee said there on CNBC, it's really about why the Fed is cutting rates. And as long as the Fed is cutting rates because the economy is still doing okay, sure, there's areas that are soft, that's going to be good for small caps. And as Tom Lee says, this small cap rally that we have seen is not a trade, but it's really potentially a multi-year theme as investors are buying IWM, for an example, the ETF for the Russell 2000, because we're expecting 7% faster EPS growth rates than the S&P, and because the median stock in the Russell is trading at over 2 times as cheap as the S&P 500 itself. So based on that metric, you could see a massive rally in the Russell and still be trading at very attractive levels relative to the S&P, and that's basically what Tom Lee is saying. Now, tomorrow's event with the Fed will be really confirmation of this Russell trade, and we'll talk about that here in just a moment. But first, I want to go over some of the news that came out today that sent stocks tumbling. The S&P was down about 0.5%. At one point, you were down over 1%. Now, we're not quite to the end of the day, so obviously it can get pretty volatile here in the next hour or so, and these numbers may fluctuate. And you can even see a stock like Nvidia that was down over 5% today. Microsoft down almost 2% heading into their earnings report after the bell today. Amazon down 1.3%. Meta down 0.5%. Apple down another 0.5% today. It was a rough day for big tech across the board. IWM did hold up much better than the other areas of the markets, with the Russell that's actually green, up 0.2% at the time of recording this video, relative to the S&P down 0.5%, which this outperformance of the Russell today is quite remarkable because we did get JOLTS job openings that came in at 8.184 million. We were expecting a flat 8 million number. So this actually came in 180,000 jobs or job openings higher than expected. That's not necessarily good news for the Fed and kind of tightening up the labor market. There's more slack to the labor market than we thought. But this is a good sign for economic activity, because the last thing you do if the economy is getting worse and we're heading into recession is look to hire more people. And that's what is going on. Business owners are looking to hire more people. So this is actually a good sign for the economy, but not as much so a good sign for the Fed, which again is kind of surprising. The Russell is doing better than the S&P today in spite of this data. We also did get CB consumer confidence that came in at 100.3. We were expecting 99.7. So consumers are feeling more confident than they did last month. And that's also a good sign for the economy, considering consumers spending money is over 70% of the economy itself, of your GDP report. A little bit of good and bad data, depending on how you want to look at it. Now, this news today was massive, and this sent markets down a lot when you first got this, because the S&P was actually green today, and this was the news that started some of the carnage out there. And it reads like this, quote, Bank of Japan to consider additional interest rate hike, including raising rates to around 0.25%. Now, I'm going to give you the summarized version of why this is negative. Japan owns the most U.S. debt, the most U.S. treasuries of any foreign country. While Japan has not raised rates in a long time, they've suffered from deflation. Now they're starting to have some inflation. So Japanese investors, citizens, and corporations have bought U.S. debt instead of Japanese debt. Now, simply put, if you take a look at TLT, this is the 20-year Treasury ETF, when you get buying pressure that goes on to TLT, bond prices go up. That means bond yields go down. It works like a dividend stock. Prices go up, yields go down. Well, if you theoretically see the Bank of Japan start to raise rates and investors start to sell U.S. treasuries and take that money back to Japan, which is the fear, you would get more selling pressure in bond markets. That would drive down the price of bonds, and that would drive up the yield of bonds. So that could theoretically raise the yields of, let's say, a 10, 20, 30-year treasury, or even shorter term duration treasuries for that matter. Now, this news did have a larger effect on the treasury market in the beginning of trading today, but you can see now 10-year treasury yields are trading at 4.14%. You're actually down over 3 basis points today. And it's because of this news. The Israeli military says, quote, "We carried out a strike in Beirut in retaliation for the attack on Golan Heights." Now, what you actually seen when this news came out was a sell-off in stocks and a bid in bonds. So investors went out and started buying bonds. When bond prices go up, again, yields go down. So that is what helped push 10-year Treasury yields back down today. But this is what you call a fear move. This was a move where investors, they sold stocks, risk-on assets. They bought safe assets or safer assets like treasuries. And yes, you did give some of that back, but you're still holding up, about half of the rally that you've seen in treasuries based on this news. This is not exactly a great sign. Whenever you really see fear moves, that's never a good sign. One of the most notable fear moves that you have ever seen before in treasuries was the Rona crash, where basically everyone piled into treasuries for about 2 weeks, and then obviously they got sold off and there was a lot of volatility. But anytime you see investors sell stocks and buy bonds, that's usually a sign of more volatility to come. So that was also big news today. Then part of the equation that is sending the S&P down about 0.64% at the time of recording this video is the fact that we have big earnings today and after hours. You can see Nvidia's down over 5%. At one point was down almost 8% today. We have AMD earnings in after hours. We have Microsoft. We have Starbucks. We have Arista Networks and a couple of others, including Pinterest, First Solar, Caesars Entertainment, Lemonade, Electronic Arts, and GeneX. Now, in this market environment where you're in a downtrend and specifically around big tech, it's been a lot of this sell first, ask questions later kind of mentality. So what you're seeing, in my personal opinion, at least today, is algorithmic selling programs that are just selling these big tech names. Now, whether or not the earnings are good or bad or meet expectations, that's a totally different topic of conversation. And I would expect good earnings to be rewarded at least somewhat favorably. Bad earnings are going to be destroyed. Your stock's going to get wrecked. And inline expectations or inline earnings, probably expect, a minimal upside or minimal downside move. But that is also having a big role to play on markets today. Not to mention, we have the Fed tomorrow, and that's going to throw another big event for markets. And again, where I'm a little bit concerned heading into tomorrow is the markets are expecting a 100% chance of a September cut. Now, we have Jackson Hole that is mid-August. Do we get a Powell that confirms the market's expectations? Do we get a Powell that comes out and says something along the lines, I'm going to paraphrase something I would expect to hear from Powell if he confirms a September cut. It would go something like this. We have gained further confidence that inflation is heading back to 2%, and we should begin the process of cutting rates as soon as the next policy meeting. We will be data dependent and the path may change, but we deem it appropriate to begin the process of cutting rates. It would be off to the races, okay? That would be confirmation of a September cut. If Powell says we still have a long road ahead towards getting inflation down to 2%, we have gained greater confidence that we are heading to 2%, but we are not, it may take some time or something along those lines. Fill that in there. And we will remain data dependent, something along those lines, but does not confirm they're ready to start cutting rates. Yeah, you're going to get more downside for markets, a lot more downside for markets, because we're expecting 100% chance of a September cut. Now, it's possible Powell just stays really neutral tomorrow and then waits for the next CPI report that'll come out before Jackson Hole around August 11th or 12th or so. You'll get that CPI report. And then if the CPI report's good, Powell confirms that September cut. Now, you'll get another CPI report before the September Fed meeting around September 11th or 12th. So really, I'm looking at markets right now and I'm saying, with 2 more CPI reports before September, does Powell really want to jump ahead of 2 CPI reports and televise to the markets that they're going to be cutting rates? I don't think so. I don't. I mean, I think it's hard to make that argument for any logical investor, because what if the next two CPI reports come in a little on the hot side, theoretically? I mean, it looks like there's a lot of downside momentum. Inflation's doing well. But what if we get two more CPI reports before September that are bad? Then the Fed's going to have to come out and jawbone the markets and say, we don't have any confidence that inflation, or we don't have as much confidence, inflation's heading back to 2%, and kick the can down the road to maybe November. I don't know if the Fed wants to get ahead of themselves two CPI reports before the next Fed meeting. Now, if they don't confirm the September cut tomorrow, and instead they wait till Jackson Hole and get one more CPI report in the belt, then they're only going to be confirming a September cut with one CPI report. One hotter than expected CPI report. Maybe the Fed can justify still cutting rates. But theoretically, if they confirm a September cut tomorrow and we get two hot inflation reports back to back before September, that's a bigger problem. So hopefully you understand what I'm saying. I don't think the Fed's going to confidently confirm a September cut to us if we get the July and August CPI report before July. But if they wait until Jackson Hole mid-July, they at least get the July CPI report out the way. And then from the Fed standpoint, who really cares what August CPI is? Because that's only one report. We can still justify cutting rates even if one report comes in a little bit hotter than expected. So, I mean, from that standpoint, it doesn't make sense why the Fed would outright confirm a cut in September. Now, they might sound a little bit more bullish, but the markets are pricing a 100% chance of a cut in September. That just doesn't seem that likely to me. Not at this stage, not with, 6 weeks until the September Fed meeting. And again, two more CPI reports before September. But let me know what you think about that down below in the comment section. I do think markets have fallen a considerable amount. The S&P perhaps would be better priced for a little more relative hawk Jerome Powell tomorrow. Now, small caps would be the ones that would really take it on the chin, because they have been rallying based on this narrative of a September cut. And again, whether or not we get a cut in September really doesn't matter for tomorrow. It's just the foreshadowing for that cut. If there is no foreshadowing for a September cut from the Fed, that becomes very problematic for your small cap index. I don't know. I think the risk to reward here just doesn't look good with the markets pricing in a 100% certainty of a September cut. If the markets are more like 50-50 between a September and November cut, I would feel a lot more confident heading into tomorrow, specifically in regards to the Fed. But, we're not. We're pricing in a guarantee of a September cut. And I don't think we're going to get a guarantee of a September cut from Powell tomorrow. Now, with that said, you may perhaps see the trade of, big tech again. Big tech may be the concentrated trade coming tomorrow. They may, big tech, as long as Microsoft earnings are not bad here in after hours, or AMD, you might see some inflows into big tech and outflows from the Russell. That would be my expectation heading into tomorrow if Powell does not confirm a September cut. And there's a lot of potential ways to trade this and hedge this. Potentially it's go long S&P, puts on IWM, vice versa. If you think the Fed will confirm a cut, or potentially, going both ways on both index ETFs could also make some sense. There's a lot of different ways to trade this. And I think we're going to be in a period of extreme volatility for a period of time. Now, I also want to remind you that the Fed tomorrow is at 2 p.m., the report. The Fed itself is at 2:30 p.m. So you can wait until the event to actually position your portfolio appropriately. Once you get the information, it's better to react a little bit late than to react early and be dead wrong, right? So I would encourage you to potentially just wait until we get the information before actually going out there and making some crazy trades overall. But again, I'm not a financial advisor. I'm not a financial planner. Just been in the markets for a long time. Nonetheless, guys, that is going to go ahead and do it for this video. That is what I have for you for today. Let me know what you think, again, down below in the comment section. Hit the like button and subscribe to the channel if you made it to the end of this video. Most importantly, enjoy the rest of your day, and I will see you in the next one.